Today we're going to be walking through design comparisons for IUL policies that are for the same person or example person, in this case, a male who's 25 years old, similar to the video that we previously did for a whole life policy design comparison. In that case, it was Penn Mutual. The scenario today will be for most of the policies, a 25K per year fund, and we're going to walk through the worst design policies to a slightly better design policy, then to an okay design policy, and then we'll look at some of the optimized designs that would be ideal for cash value growth. Because that's the goal with all of this in the way that we like to design policies. It's really for that cash value growth to be used as your personal line of credit with net wealth finance to finance cash flowing assets. So let's get into it. Okay, so first we're going to talk about what this sheet is set up with. And we've got a number of different policy designs on this sheet. And here at the top, we're showing the estimated commission, some of the details of what went into the design of the policy, the MEC limit, in this case, the annual MEC limit, the guideline annual, and the minimum premium. So some of our other videos will go more into the concept of the MEC limit, but effectually that's the amount that you can put in a given year without turning this into a modified endowment contract and effectually losing the tax benefits of accessing the funds while you're alive. So each of these sheets has all those things, and we can use those for comparison. So we've got the worst design, we've got a bad design, we've got an okay design, we've got the optimized design that is still a 25K fund, and then the optimized design with the max term blend ratio so that we are funding it at a higher level. All right, so now we're going to walk through starting with the worst design and looking at this sheet to kind of compare where things are. All right, so jumping in with this worst design, what we're doing here again is a $25,000 a year premium, but what we can see is that year one agent commission in this case is $28,000, and that's pretty crazy. So where does that come from? Well, that's going to come from your cash value, your ability to access cash value in that policy. That's how they're going to have to recoup those costs in order to do that. And so what this policy is a level death benefit, and it's all that base, expensive, commissionable universal life insurance. So there's really not a scenario where I would think anybody should get this policy. There's better ways to, if you wanted to put this amount of cash and have this amount of death benefit, there's better ways to go about it, and we'll get into some of those in this video as well. So I just really wouldn't recommend this for most people. But the max that we could get into this per year, so this is optimized at least for what it is $25,000 per year. And then the minimum premium in this case, because it's all base, if you don't put this $23,000, almost $24,000 in per year, then this policy could lapse, and that is not a good thing. It's not what we want. So in this policy, this worst design policy, we can see that there are 3 0 years of cash value. So the difference between cash value and accumulation value in an IUL is the accumulation value is what they base the crediting off of when you're indexing. I have other videos breaking down the concept of indexing, so check them out. I'll probably pop up a playlist for that. But your crediting is based on your accumulation value, but what you actually have access to is based on your cash value. So in this case, you will have put in $75,000 into this policy over 3 years, and you'll have zero access to those funds. If you surrender this policy in that 3-year period, you will get zero funds back out of this policy. This is really bad. And like I said, I don't think that there's anybody who should be getting this policy. So in year 4, you finally start to see some cash value, and it starts to look okay. And here on the right side, we're looking at the cash value difference from the optimized design. So in year 1, the optimized 25K fund has $20,553 in cash value in year 1. So like over 80% of that year 1 premium is going to cash value in the optimized design. So before we deep dive into the worst design policy, we're going to take a look at each of the factors at a high level for the different policy designs. So the bad design policy is lower commission than the worst design. So in this case, $8,400. And what we changed here is an increasing death benefit, and what that does is we're not going all having to put the death benefit so high initially in order to be able to put this amount of cash in. So the MEC limit is almost the same; it's right around 25,000, which is what optimizes this. And the minimum premium significantly lower. When we compare to the worst design, which was 23,000, almost 24,000. The bad design, now we're looking at doing 7,142. That's the minimum premium that you can put into this bad design policy. So it's still not great. I don't like this, but it's significantly better than that worst design policy. Okay, next we're going to jump to the okay design policy. Now, again, we're going even lower on that estimated commission for the agent. What does that mean? It means you are getting into more cash value in year one by having that lower commission because there's less cost to recoup. We are also doing an increasing death benefit, and we're doing a term blend. So we're mixing in some of that non-commissionable term in order to make this policy a bit more efficient, and that's what's getting us to almost the same MEC limit, but the minimum premium, again, it comes down significantly from even that bad design. Whereas the bad design was 7,142, this one we can get away with putting in as little as 3,828 and keep this policy in force. So still reducing the amount that you have to put in order to make sure this policy stays in force. All right, now we're going to jump in with the optimized 25K fund, and look at this. We're significantly lower. So we're bringing down that death benefit to the minimum necessary, but we're also blending in to the best we can for this funding level, but still keeping that MEC limit where it needs to be. And the commission on this is significantly dropped. We're looking at $1,300 of commission, which is what leads to that year one cash value being over 20,000, being over 80% of that year one that you've paid in premium. That is what you have access to. And the minimum premium in this case is $1,567. So if you hit financial hardship for whatever reason and you want to keep this policy in force, you just got to come up with $1,567 each year to keep this policy in force. So it's really, this is a good policy that if you're looking to put this amount of cash in, this would be a reasonable way to go. Now, jumping over to the optimized max fund, we are changing the funding level, but notice the commission doesn't go up because all we're doing is we're increasing that term blend to be the maximum ratio that we can for this carrier, and that's what gets us access to the optimized policy design. And you can see that by doing this, we're going up to the MEC limit or thereabouts. So the MEC limit in this case is $43,464. And this is showing a funding level of $43,400 per year. So what that's going to do is it's going to accelerate your break-even point. Now, all of this is based off of crediting that's around like 6 or 7%, which I think is realistic based on the historical index performance. I think we should outperform that. So this is sort of conservative in my mind. I mean, there's no guarantees, but we should expect to outperform that. And so this is going to increase that break-even period because we're going up to that max blend and optimizing how much cash we're putting in to hit that MEC limit. And so, you can see here that this is basically, it is a year 3 break-even. So that's pretty good in terms of getting to an optimized state, and you have like a really close to, I don't know, I think maybe that's 90% cash value, or approaching 90% cash value in year one. This video is part of a series. Check out the playlist here. If you want to learn more broadly about net wealth finance as a strategy and whether it makes sense for you, check out this playlist. If you're already ready to book a meeting, then check the video description. We could work with you to determine whether or not this makes sense for you to employ in your life. Thanks for watching. We'll catch you in the next one.